the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, the Singapore Straits Times Index was down 0.4% at 4,255 points at about 11:59 a.m. Singapore time. And that is with a value turnover of 900 million dollars seen in the broader market. So generally speaking, shares fell as investors digest this flurry of earnings out of the country in recent days. Now let's take you through the closing numbers. The STI ended in the red as well, down 0.38% at 4,256 points. In terms of value turnover, that's 1.92 billion Sing dollars. Gainers trailed losers 253 versus 280. Top advances for today we've got for you GMH USD, SGX and Soil Built Construction. And top decliners, let's take you through them. We've got here DBS, ST Engineering and iFast. Now, in terms of counters to watch, we have CapitaLand Investment because the group today posted net profit of 287 million Sing dollars for H1 ended June. 13% down from the 331 million Sing dollars seen in the year-ago period. Elsewhere, from house shares of ST Engineering tumbled 6.4% early on, despite announcing better first-half results. To Lenovo's earnings, we've got more corporate and international headlines in focus. Also on deck, a quick look at Foxconn's latest results, plus how Bitcoin hit a record high on the back of financial reforms and rate cut bets. Now, joining me on the line on a Thursday is David Chow, Director at Azure Capital. David, welcome back to the show.
Hi, Tintin. Hi, everyone. Well, we are back to that time of the week.
Yeah, back on a Thursday. Now, let's start with the Singapore stock market as usual. David, how did the STI fare today? Any surprises when it comes down to the biggest movers?
I think the Singapore market will continue to consolidate, at this juncture, with the catalyst, seem to be brought by the Nikkei market today, which, I think fell about 1.5 today, following Bessent's statement, that they expect the BoJ to hike soon. And, apart from the Singapore market, which fell 0.4% at close, most of the regional markets, fell as well. And looking at some of the individual counters in the SGX, you pointed out, a couple earlier on. And for me, I thought, counters like Making Studios from the gaming industry and even Pan United from the construction sectors, which both fell today, warrant some attention. This observation stems more from the standpoint of a possible closer look from investors rather than pure surprises, as we are quite aware of stocks selling off even after posting a good set of results, due to the buy on anticipation and sell on news. I'll call that a mindset.
And David, if we look at some of the companies to watch for today, we have CapitaLand Investment, the group posting their net profit of 287 million Sing dollars for first half ended June, 13% down from what we saw in the year ago period. Shares were down 4.3% as at the midday break as well. So how would you assess CapitaLand Investment's latest performance as well as investors' response today?
If you look at the share price movement of CapitaLand Investment, I think it's actually up 6.5% year to date, and the STI index, as we know, is up strong, top 12+% year to date. So on that note, CapitaLand has certainly underperformed the index year to date. I think it's down about 4% today. Quite a substantial fall for a one-day session, in my opinion. I guess the market is usually efficient for the large cap. So why the underperformance? And so if we disregard this set of results for a moment and focus on the earnings estimate of the company, since the start of the year, I can see that this figure has been adjusted downwards by I think about 12%. So this speaks volume of the sell side analysts who are actively covering this stock, and to a certain extent, they might have provided for a higher earnings forecast earlier, hence the downward adjustments now. But it certainly foreshadows this latest set of results. I guess on results specific, the biggest overhang still resides in the China operations, and if we look at China home prices this year, we haven't even seen a recovery. In July, I think the prices continue to fall. With some cities experiencing the fastest decline in 9 years. So with this, coupled with macro uncertainty which affects divestments or even deal making for them, there are certainly a few headwinds for the company. So perhaps to end off, second half, could be better, so you have somewhat more clarity on the global tariff issues. So let's see.
And David, another counter we want to keep our eyes on is ST Engineering. I mean, shares of ST Engineering tumbled 6.4% early on, despite announcing better first half results. How far then can the movements be attributed to profit taking, and any major concerns there?
Well, I think ST Engineering, as most of us will have noticed, has been one of the best performance this year in STI rate. It's rising by 80% versus the 12%. So a lot of good news have already been baked in. So in my opinion, I think it's a combination of profit taking as well as reaction to the ongoing market consolidation of the STI index. And looking at results specifics, the results were quite decent in my opinion. The net income, up 20% year on year to about 403 million, and the top line, was up 7.2%, I think, to about 5.9 billion. So it's really a really good set of results. And if you look at the total book, for the period end, I think it amounted to 31.2 billion. And this alone, actually provides up to 3 years of revenue visibility, even if the company, stopped winning any new contracts from now on. So I guess, as long as, structural tailwinds such as, a rising global defense spending is still ongoing, and if the company's, mitigation measures on tariff impact continues to be effective, like the first half of the year, it should continue to put the company in good standing, and this will probably sustain the company's high for a period of 31 times now. But at this level, I guess you will need much more sustained new good news to propel the stocks upwards.
And across the region, David, you mentioned it in brief earlier as well, how the Japanese yen rose significantly against the USD, climbing to its highest levels since late July after, of course, U.S. Treasury Secretary Scott Bessent said he had told the Bank of Japan governor that it was behind the curve in its fight against inflation. What do you make of the news, and really what are the levels to watch when it comes down to the Japanese yen?
Expectations is a very important aspect of the financial market. So, with this statement, this has certainly fueled market expectation of a more hawkish, BoJ policy, potentially leading to, further interest rate hikes to combat inflation. So this has boosted the yen, so we know that, higher interest rate typically strengthen the currency by attracting capital inflows. And the yen strength could be further supported by a policy divergence with the US, where expectations of, a Fed cut happening in September, are actually growing at the moment. However, we see that even as this yen may rally in the coming days, it will face many challenges. If you look at Japan's economic data, I think we are looking at 6 consecutive months of falling real wages in June, and concerns about U.S. tariffs could still delay BoJ rate hikes, eventually potentially capping the yen's upside. So if I look at it on a technical level, I see that the technical levels actually suggest quite a delicate balance with the pair recently breaking below the 200 period, simple moving average around 147, which indicates to us some bearish momentum, but also nearing oversold conditions, and this could actually prompt consolidation or a modest rebound.
Now, if you're just tuning in, we're now in conversation with David Chow, Director of Azure Capital. And David, it seems like we're always talking about either TSMC or Foxconn on a Thursday.
Right.
So this time around, Foxconn, the world's largest contract electronics maker and iPhone assembler, reported its results just a while ago. Take us through the key numbers. I'll just mention a few. Its Q2 profit jumped 27% on booming AI server demand. So any initial thoughts on the numbers? Did they live up to your expectations?
Right. I think with this set of numbers, they have beaten consensus on the bottom line and actually met market expectations on the top line. So overall, it's an excellent set of results. For our own expectations, we actually estimated a net income of about 40 billion, and their reported net income, I think, was 44.4 billion. And of course, it was up 27% year on year, as you have said. And this 44.4 billion also beat, as I said, a beat market estimation of 36 billion. And top line wise, I think they came in at 1.75 trillion. While we had 1.9 trillion, while we have expected 1.75 trillion. So it sort of topped our consensus on this item. And I think in recent times, the assembly of AI servers for US tech giants such as your Amazon and NVIDIA has become a major focus for Foxconn as it tries to diversify its revenue streams. The company, as we know, is a key Apple supplier, and they're also looking to grow its EV business further. And so if you zoom in specifically, I think for the cloud and networking products, again, including our AI servers, actually accounted for, slightly more than 40% of their second quarter revenue, making it as Foxconn is the biggest business revenue ahead of their smart consumer electronics. So to highlight, I think according to management, I think when I was doubting it earlier, I think they said that AI servers are poised to continue to drive Foxconn top line in the current quarters, and the contract manufacturer is projecting a more than 170% revenue gain from this quarter. So this is quite in line with the increased AI capex spending theme that we have touched on at various points in the last few months. So this is, I think, something to look out for.
And in the meantime, David, another company to watch is Lenovo Group. It reported better than expected profit after companies accelerated their personal computer or PC purchases to get ahead of potential new US tariffs. Now, if we look at Lenovo's earnings, net income for the June quarter rose 108% to $505 million, beating the average of analysts' estimates by a wide margin. What's your take on the performance, and how far can that positivity now be sustained, given that we now have a little more, would you say a little more clarity on the updated US tariff rates?
Yes, a little more. So, little bit more. So while net income, you're beat by a huge margin, I think the revenue, which rose 22% year-on-year to 18.8 billion, also, beat by a wide margin, and it surpassed expectations of just about 17.4 to 17.6 B. So I think this strong showing, is really driven by, its accelerated, PC purchases ahead of that potential of the new US tariff, and of course, to a certain extent, a growing demand of AI-enabled PCs. And this also underscores Lenovo's operation resilience and strategic adaptability. However, the sustainability of this positive, particularly in light of the updated US tariff developments, still warrant a closer look at some of the key drivers, challenges, and market dynamics. If you look at I think the global PC market, as far as I remember, I think it grew about 7% in Q1, driven by your pre-tariff stockpiling and a lot of AI PC adoption, with I think Lenovo outperforming competitors, I think like HP and Dell at that point in time. So a 90-day US-China tariff pause, will still provide some temporary relief, but Chinese exports, including PCs, I think still face a 30% US tariff, while US export to China, still face a 10% tariff. So despite the profit beat, right, you can see that what happens to Lenovo Hong Kong share today. I think it fell about 3 to 5% post earnings. So it actually reflected, investors' concern about tariff uncertainty and sustainability of PC demand.
And finally, before I let you go, David, Bitcoin hit a record high today as increasing expectations for easier monetary policy from the Fed added to tailwinds from recently announced financial reforms. Basically, last week, we saw an executive order by Trump paving the way to allow crypto assets and 401k retirement accounts. Now, if we look at Bitcoin, it climbed as much as 0.9% to some $124,000 in early Asia trading today. What do you make of the news? How concerned are you about this?
There are a few catalysts in play now. I mean, as far as we could all see, growing expectation of U.S. Federal Reserve rate cut, as you have put it earlier on, and the order from Trump signaling a more favorable regulatory environment, allowing crypto assets in 401k retirement accounts certainly helps a lot. And this is also followed by, again, strong institutional interest with inflows into crypto ETF and corporate adoption, adding to the momentum. So what does all this mean? I think the move could potentially mark a potential turning point in crypto's legitimacy, opening the door for retirement portfolios traditionally just limited to stocks and bonds. And with over 90 million, I think, Americans in the 401k plan, I think cryptos could channel trillions into digital assets. Yet, I guess if you take a step back, the uptake will really depend on the regulatory guidance, employer adoption, and most importantly, fiduciary comfort. So So although the executive order by Trump is a big signal, so actual implementation as far as we are concerned will probably take months or even years, as regulators, plan providers and employers, they have legal, administrative and even liquidity challenges. So in the short term, looking at the price movement, the record price surge is not surprising given the convergence of macro expectations, and of course it also reflects momentum driven by sentiment and policy shift. So we really need to see what's in for cryptos going forward. So before I actually end off, with the rise of cryptos, we are likely to see more finance professionals coming to the market to actually assess cryptos. And talking about financial professionals, I would like to take this opportunity to just give a quick shout out to everyone preparing for the CFA Level 3 exam next Tuesday, especially that's why you have got this. Just keep pushing.
Okay.
Thanks.
Just keep pushing, and meanwhile, we'll keep an eye on market movements as usual. Thanks so much for the insights today, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.